Okay, so what is liquidity preference? Basically, this is a Keynesian view about the demand for money. In other words, liquidity means cash, and why do we prefer to have cash is what they're talking about. But before we talk about the desire to hold cash, basically demand for money is like your desire to hold cash. Before we talk about that, we want to talk about something to do with cash or money. We want to talk about something which is called the opportunity cost of holding money. Our desire to hold money is basically what we say is your liquidity preference. But money supply will actually help us in gaining liquidity as well. So we'll soon see that we will be using liquidity as a term. But why? Before we talk about desire to hold money, I wanted to talk about something called the opportunity cost of holding money.
So why would you want to hold money?
Exactly. But before we talk about why we want to hold money, when we hold money, what do we lose out is what we want to talk about. What's the opportunity cost of holding money? And we say this: the opportunity cost of holding money is basically the interest foregone. So for us, the price of holding money is the interest that could have been earned if you were not putting your money in your pockets or with yourself, but putting it in a bank or buying what we call a financial asset. So the opportunity cost of holding money is interest foregone that could have been earned if the money or wealth of yours or wealth was held as or in a financial or was used to buy a financial asset, like a bond or like a putting it in your even like a saving account, and all that could have made you earn some interest. And that's why for us, interest rate is basically the price of money. So interest rate is the price of money. Do we agree with this? So why do people hold money? We say that there are this is what our liquidity preference is. Sure, liquidity preference or motive for holding money comes from three sources. One is what we call your transactionary motive. Another one is what we call your precautionary motive. And the third one is what we call your speculative motive. So these three make up your total money, what we say money demand for money or liquidity preference. And this transactionary, precautionary combined together, we also call them sometimes active balances. Active balances mean money very likely to be spent. This speculative demand for money is basically what we say, sometimes another name for this is what we call idle balances. Idle balances, which is not very likely to be spent. And I'll come back to this idle balance thought again, but the way we demarcate this, that active balances plus idle balances combined together is your total money demand. But active balance is something which is very likely to be spent, while idle balances may not get spent. Idle means not active. Basically, you may need to spend it only when there is an opportunity, but that opportunity is not really frequently happening. So we'll talk about that in 1 minute or few minutes and so on. Okay, let's talk about transactionary motive first. Transactionary motive is basically when you are holding money to undertake transactions, your day-to-day transactions, your day-to-day sort of buying of goods and services, like आपको your groceries that you need to buy and so on, or sometimes you come to school with some amount of money for transaction purpose, right? You know that you need to go to a canteen, you might find hungry, you may want to sort of buy a sandwich or whatever, so that's some transaction demand for money is that money. And we say this, that this kind of money has a direct relationship with the GDP of the country. So for a country, transaction demand would actually be going up if the country is rich and making more goods and services. So more transactions can take place when the GDP is high. So higher GDP leads to higher transactionary or higher amount for transactionary purposes. People will keep large balance. People will keep more balance. A lot more people will keep balances when they know that there is more goods to buy. So we believe that this actually maybe richer countries might have more money for transactionary motive because they're more GDP. Also, higher income means higher transactionary sort of demand as well for individuals, if you look at it. Okay, so we believe that there's a direct relationship with GDP of a country. More GDP, more output means more transaction will take place. Are we good to move on? So we said this, that number one, it has a direct relationship with your GDP. Second important idea that you need to understand this is that it also depends on your frequency of payment. Frequency of payments. If I tell you, you get paid every day, at the end of your day, you get a payment, daily wages आपको मिल रही है, would you be keeping a lot more money for transactional purposes or would you keep less money for transaction purpose? Yeah, you'll be like, I don't need to keep my money in my pocket from my bank account because I get paid every day. If you get paid every day, you don't have a stress of carrying money for transaction purposes because at the end of the day, you get some money, you can use that for the day, for the next day, and then at the end of next day, you'll get more money and so on and so forth. We say that basically lower frequency of payment, let's say monthly payment मिल रही है आपको, या bi-weekly मिल रही हो, bi-monthly मिल रही हो, so lower frequency of payments would mean lower or rather higher demand of for money for transactionary purposes. Just frequency of payment is like, for example, in some countries you may be paid bi-monthly. हर 2 हफ्ते बाद आपको मिलती है, so frequency of payment would be higher versus so people are paid in intervals, right? So that interval could be more frequent versus less frequent. Normally in Pakistan the norm is that you paid every month, so my money would come in my bank account every 4 or 5 days. I'll go to the ATM, I'll get some money and I hold money balances. But if they were paying me every week, for example, I might have more frequency of payment and therefore I might not need to keep that much cash. Let's say if I daily wages अगर आपको मिलती हो तो आप probably आपको अपने balances को जो भी आपको daily मिलते हैं, you probably be keeping it in your pocket. So we believe that more the reason why people actually hold money balances is because वो जो liquidity की बात की थी, like you have cash in your hand. If you daily basis pay, if you get cash in your hand, then your frequency of payment is very high. You don't need to demand that much money then. Are we going to move on? So this is your transactionary demand for money. One may argue that this would be the case. Yeah. Okay. Moving on. If you look at this transactionary demand, so this is the story for transactionary demand. Now I'm going to move on quickly to precautionary demand. Precautionary demand for money, on the other hand, is basically that demand for money that happens because people are keeping some cash for unforeseen events or unexpected sort of bargains. Like you might say, okay, You know, like there might be an unexpected bargain that might happen, and you might need more cash, keep some cash. This is not like a bargain that it is a property of $1 million property that you wanted to sort of have a bargain. This is like a small bargain, like sales happening or whatever, or cheap deal somewhere, and you like, you know, buy one get one free. You're like, oh awesome, I'm going to buy 2 shirts now. You know, like that kind of a deal, not like a big deal of you getting a huge house or property. Because that would be investment, that would be towards the speculative side. But this is simply unforeseen and unexpected bargains. And combined together, we call them active balances. Now, what do we mean by active balances? If I draw a diagram for it, if I draw a diagram for active balances, my diagram will look like this. It's a very, very inelastic curve. It's a very inelastic curve. Let's call this LP1, which is your active balances. And you can see this, that even though your interest rate may go up, you are holding less balances, but not that much. It's a very inelastic graph. Not perfectly inelastic, but a very inelastic graph. Inelastic means, first of all, interest rate is the price of money. Okay, demand for money. Let me explain this idea. 2 things that I want to explain here. Number 1 is this, that this demand curve is downward sloping. Why? Because when the interest rates are low, the opportunity cost of holding money is low, you may be holding more money. When the interest rates are high, the opportunity cost of holding money is high, and therefore you will be holding less money. Make sense? So this is a downward sloping demand curve, which means that higher the price, more the opportunity cost, lower the balances you would have. Number 1. That's what. Number 2 idea is this, that it's a spending which is interest inelastic, which means not so responsive to a change in interest rates. It's the reason why it's not so responsive is because we call this our necessary spending. You know, if the interest rates are high, if I go back home and my wife says, oh, did you buy any eggs and bread and all that? I'm like, no, all my money is in the bank and I'm earning a lot of interest. My wife is going to leave me. She's going to be like, this guy is like pretty conjuice, and he's like, I can't give that. So you have to have some cash, no matter how high the interest rates are. You got to hold some balances. You can't be so like, oh, the interest rates are high, I will not keep any cash. Let's have Ramzan for the next few days because interest rates are high. Ramzan में लोग बहुत खाते हैं, लेकिन it's उल्टा. Again, behavioral economics into play. People believe that they are doing losing weight in Ramzan, they're actually gaining weight. Trust me. That's why I'm not recording this one. Okay, let's come back. We're now recording this, so let's. Okay, so are we happy with this interest in inelastic relationship? Is there any question? Are we going to move on? Okay, now we come to something which is speculative demand. Are we going to move on, bacho? Okay, speculative demand is basically when we treat money, when we treat money as a financial asset. You know, for you, money is a way to make more money. You know, like this is where you are looking at. And what's the nature of a speculator? A speculator buys low and sells high. So he's waiting for a deal for such that he will buy low and he will sell high. Sorry, so we treat money as now I want to talk about this, an important idea that we want to talk about is this, that when you are a speculative demand for money, this is, for example, this could be large balances as well, by the way, because यहाँ पे you're looking at buying shares and bonds and sort of even like properties, and you are keeping money in your hand only because you know that as soon as the price of financial asset or any other asset will go down, I'm going to buy that asset. And when I buy that asset, as soon as the price goes up, I'm going to sell that asset. However, this is the kind of demand which could be very responsive to interest rates. Basically, we're saying is let's write this in words, that speculative demand for money is when firms and individuals who wish to buy financial assets hold money balances if they believe the price of these financial assets is likely to fall. Now, can I have 1 minute of attention? So basically what we're saying is this: if your expectation is the prices of financial assets are likely to fall, you will hold these balances. And if your expectation is the prices are likely to go up, you will hold less balances, because you'll be a fool to hold balances. अगर आपको पता है कि prices will go up in the future, rather you should not have the balances. You rather be buying those assets before they become completely out of your range. So what we believe is this, that when you draw this graph for speculative demand for money, it looks like this. It's a very interest elastic graph. And what we say is this, that if the interest rates are going up, you will be holding less money balances, because this time around, this is when you're treating money as a financial asset, and you tend to lose more. So what we say is this is a very interest elastic demand for money. Why? Because when the high interest rates would mean you lose out much more. Will lead to a higher opportunity cost and therefore lower demand for money. We will hold less money balances because we know this, that we are holding money to make more money. But if you are interest rates are very high, you better off to just keep it in the bank and make money through that, rather than keep it in your hand and wait for a good deal, wait for the price of an asset to go down. So opportunity cost is very high, and that's why it's very interest elastic. And also it's called idle balances, which is not that likely to be spent. You're not really keeping it because there will be a daily need for it or a frequent need for it. And that's why, combine all this together, you have what we call your liquidity preference. So your demand for money basically would be all these three things together. And what we do is we draw a curve like this. We say that demand for money is like this. We call it liquidity preference, which is your transactionary plus precautionary plus your speculative demand. You're all the active, and I'm basically making a curve which is not very elastic, not inelastic. We'll talk about the shape later in another discussion. And therefore, we have a curve like this. Okay, now I want to talk about something which is called equilibrium. Equilibrium in the money market. So what we mean to say is this, that if you look at equilibrium in the money market, now we'll bring two things together: money demand and money supply. Yesterday's discussion was about money supply. We saw how government is trying to change money supply through various ways. If you look at money supply diagram, according to the Keynesians, this is how money supply looks like. For them, money supply is completely fixed. They say this is how the money supply looks like. It is not dependent on interest rate at all. The government decides to fix that. The government says this is the money supply which is in the market. How do they change this money supply? We saw that they can change this money supply through reserve ratio, through your open market operations, through your deficit financing, and so on and so forth. Right? So this is money supply which is fixed by the central bank. So money supply is fixed by the central bank. Perfectly inelastic is your money supply. Your money demand, on the other hand, we just saw that money demand is your liquidity preference. Okay, liquidity preference, which is your money demand, which is your transactionary plus precautionary plus speculative demand for money. Make sense? Where money demand and money supply meet, this is what Keynesians say would be your equilibrium interest rate. So according to the Keynesian theory, the money demand and money supply's interaction leads to what we call equilibrium interest rate. Talk about something which is an equilibrium idea. Look at this, guys. Why is R not an equilibrium? What if R naught was not the equilibrium, but the government decides on its in its whim like R1 will be the interest rates? Is that equilibrium? And the answer is no. Why? Because the money supply is more than money demand. What do we mean by money supply more than money demand? This means more liquidity in the market than it's needed. People have more cash. Do they go to the banks and ask for loans then? Will they seek loans? No. And price of loans is interest rates. There will not be need for people to take cash. In fact, if I have money, I'll be like, yeah, मेरे पास पैसे पड़े हुए हैं. Would you like to take a loan? He'll be like, yeah, how much interest rate are you charging? I'm like, R1. He's like, no, man, this is too expensive. Give me something lower. And I'll be like, okay, how about R0? He'll be like, awesome. Right? What is happening is this, that because of more liquidity, people will there will be a downward pressure on interest rate. Because people who have excess cash, no one is taking a loan, no one is sort of taking liquidity that you have. So when MS is greater than at R1, what we believe is that MS is greater than MD, there will be a downward pressure on prices, which in our case is pressure on interest rate. And we'll come back to R0, which is basically our equilibrium. Vice versa, अगर आप R1 पे नहीं हो और अगर आप R2 पे हो, this is when you look at a situation where you can see this, that MD is greater than MS, which means that you have lack of liquidity. You have people who are like saying that we need money, but we can't meet our demands. We're not able to meet our demand. What would that do? People will seek loans from other people who will be like, give us a higher interest rate so that we can give you a loan. So there will be what we call an upward pressure on interest rates.
So people take loans from the bank.
People take loan from the bank, or you and I, whoever has the money.
Bank make a profit from the loans.
Bank makes a profit from the loan.
Like the bank would want to lower the interest rates so that more people come and take loans.
Well, if the need is more, they will increase the interest rate. They to make money, right? So if the R2 is the interest rate and there are like 20 people asking for loan and I have only enough amount of money, I'm going to like, okay, I'm going to increase the price. Who's going to take it? It's like how the auction market works, right? So it's more like that kind of a thing.
But like
So equilibrium happens at R0. One last thought which will actually help us to come back to what your point is, and I want to talk about this, that so let's say right now, quickly let's just discuss this thought because it's an important thought to discuss. Let's say this is my money supply. Let's quickly draw this. Money supply is like this, and let's say money demand is like this. Okay, this is my quantity of money and your interest rates. I just want 2 minutes. So interest rates is this. The government decides to increase the reserve ratio. If they increase the reserve ratio, what happens? lower lending. Isn't that true? Lower lending would mean money supply will fall. Money supply goes down, this is what the government does. If the money supply goes down from from MS naught, the money supply will now go to MS1. So money supply will fall. And when money supply goes down, we will see that the equilibrium interest rate will go up. And that when R goes up, so money supply goes down, and that's why R goes up, and that in turn would have its policy implication. Probably when the R goes up, probably you'll see that consumption will decrease, investment will decrease, and that in turn would mean, we'll talk about it later, that you might see your AD to fall. So like how does the government is controlling the variables in the economy? Through money supply, they end up causing interest rate to rise, which end up resulted in your AD to change. Like this is what we call our monetary policy at work. The monetary policy is working here because through money supply, we're controlling all other variables. And yesterday's discussion where we said, okay, you try to manage your exchange rate, you will be unable to manage your money supply, would mean you will be unable to manage this, all other variables, your monetary policy variables because of that. Okay, thank you very much. We'll discuss the rest of it on Monday.